Good afternoon, traders and investors. Will back here with another one, coming to you with a Thursday market update. So in today's markets, guys, everything getting significant lift after yesterday's positive NVIDIA earnings, really breathing new life into a market that was ready to consolidate for seasonality into February and March. But now that consolidation may just be delayed with some renewed interest and some renewed daily uptrends by the bulls. So in today's video, guys, we're going to go over exactly what happened in two earnings calls that I have prepared for you guys. Number one is going to be Booking.com. Number two is going to be INTUIT. And tomorrow we are going to do a few more. I know Square came out today, so we're going to leave Square for tomorrow. And tomorrow I also do want to cover Mercado Libre. So with that being said, we're going to go over those two earnings calls, Booking and INTUIT, over the course of the afternoon today together. And then we're going to do our major rundowns here of our indexes and major tech names. The portfolio update will be tomorrow at the close, and we'll see how we made out for the week. So without further ado, guys, let's get right into today's video. SPY up a significant 2.07%, guys. One of the best days since this whole November rally started. And QQQ almost up 3%, which is indeed the best single day since the entire 4-month rally started in November. Very significant gains, and across the board, really, participation coming in from financials, healthcare, even your growth stocks, IWM Russell participating ever so slightly in the rally. So with that being said, let's go over the group screener here, and you can see that the market performance was absolutely beautiful here. Everything in the green, namely led by semiconductors, of course, after NVIDIA earnings. Take a look, guys, at your semiconductor gains over the course of the day. Applied Materials, 5%, AMD, almost 11%. And the list just goes on, right? AVGO, 6%, a bunch of high performers. SMCI, the outperformer on the day, 33% to the upside, followed followed second by NVIDIA by about 16% after yesterday's earnings. Absolutely fantastic gains by semiconductors as a whole. The only real thing that was lagging today on the markets was utilities, once again being plagued by a little bit of interest rate sensitivity. So that being said, guys, very healthy market as a whole. 1-day relative performance, everything in the green except for your utility sector. And on the 1-week relative performance, guys, everything pretty much in the green as a whole, inclusive of today's drop of utilities. Pretty much everything except for a slight little mishap in communication services. Google slightly struggling here over the course of the week, and then you have your telecom services down a little bit. So before we get into more technicals, guys, let's go over our earnings calls right away. And we're going to start it off with a company that I like very much in the name of Booking.com. So if you guys don't know what Booking.com does, guys, they are the largest online marketplace for any travel experiences for booking online, right? So they own a number of subsidiaries. You can see here, Booking.com is the world's leading provider of online travel and related services, providing local consumers and local partners in more than 220 countries, much wider network than Expedia here. They own Booking.com, Priceline, Agoda, Kayak, and OpenTable, just to name a few. Very, very large travel aggregator. They're also part of a market that is continuously growing here, guys. You can see that they are the biggest in terms of volume that they do. So Booking.com currently in this is only of 2022, but as of currently, they generated about $20 billion in revenue. So this should be a bit higher. Expedia is followed closely in second place. They got about $13 billion in 2023, and Airbnb about $9 billion in 2023. You can't see it here, but just to show you the scale of how much more Booking.com does more in terms of business than their closest competitors, right? They also are in a market that's ever expanding. So here's your total addressable market growth by 2027 in terms of a global scale, compound annual growth rate of 15%. Very, very fast paced growing industry here. And you can see we also have another one for the US online travel. The preceding graph was for global travel. The US online travel service market is expected to grow about 8.5% on a compound annual growth rate through 2030. And this is actually something that surprised me, guys. The light blue line is people that book with direct travel agencies, and your blue line, dark blue line down below here is your online booking. So apparently a lot of people still booking with travel agents. Now, that may sound a bit strange to people of my generation and under who are so used to booking their own travel online. But just remember, guys, there's a very large segment of the market that still uses legacy ways of booking travel in terms of either calling hotels directly themselves, calling airlines directly themselves, or getting a travel agent to do it for them. They're just not as well versed at shopping online as potentially the younger generations. And keep in mind, your older generation over and above maybe 40, 45 years at this point, 45 years old at this point, right? They have significant more disposable income than us. So that is to be noted. Nonetheless, Booking.com still an extremely solid company. Yes, their share price is close to $4,000, but if ever people are interested in buying this stock, just remember that through most brokers, you can buy incremental shares. You don't have to buy one full share. You can literally buy $100 of Booking.com if you want through most brokers for a fairly low commission. So the stock price is not so much of a big factor anymore as it once used to be. That being said, guys, they are down 9% in the after hours. So what exactly happened? Well, they did have a double beat here in terms of a very nice beat on EPS and a very decent beat by about 2% on revenue here. But there's a few things with this company, guys, that we will need to go over. Down about 10%. I like this company close to where it is right now at the current share price here. About $3,500 is pretty fair for me. We did do a little bit of valuation here at the current price, so we'll see how that stands up. But a couple reasons why I like the company before we get into exactly what happened. Well, the company has low amounts of debt as a whole here, guys. So if you take a look at their debt, they really don't have that much debt in terms of the money that they bring in. So if you can see, as of the last quarter, they had about $14 billion of debt at about $13 billion in cash and cash equivalents. That has slightly changed a bit. They've boosted their cash and cash equivalents to about $15 billion now, which is over the amount of debt that they have. So very good debt management for them. They've also announced the issuance of a new dividend. So they generate a lot of free cash flow here. And now they're generating a dividend for the first time for shareholders, which will be payable in March. They also have relatively high margins for the travel industry. We're talking relatively always in the range of 17 to 21%, which is very good for the travel industry here, guys. Expedia usually averages about 13, 14%, and Airbnb, despite being inconsistent over the last couple of years, also tends to average between 15 and 20%. So very, very good margins as a whole. They have medium shareholder compensation. It's about 10% of their total revenue. So not good, not bad, right there in the middle. And they do have fairly good growth metrics here for the foreseeable future. For the next couple of years, we're talking about revenue growth of 9% and EPS expansion of about 15% year over year for the next foreseeable future. You can see that right here. Beautiful expansion of your EPS curve after struggling a bit prior to the pandemic and through the pandemic, now really getting back to delivering money to the shareholders, and revenue growth is going to be streamlined as well through 2026. So no problems there as travel does remain hot. So let's get into exactly what they said on their earnings call, and we're going to break down a few of their numbers here. So let me just zoom up to the top here. Apologies for that. I was going through it while I was preparing the video here, and let's just run back and do everything together. So fourth quarter highlights, very, very good, guys, right? It's going to be a struggle to find anything bad with this earnings report per se. A little bit of an overreaction by Wall Street, in my opinion. So they also didn't issue guidance. Their call is currently ongoing right now. Now, I do have to run for a dinner. However, I would have liked to listen to the call because they didn't provide any guidance in terms of written guidance. Most of it would have been given on the earnings call. It's just a shame that I can't listen to it right now, but most of the drop is probably attributed to what they're saying on the call, potentially some guidance into 2024, potentially some revised numbers to the downside. I'll take a look into it tomorrow, but it shouldn't be that big of a factor. Now, gross travel bookings on the quarter, very, very good. Increase of 16% from the prior year quarter. That's very good on a quarter-over-quarter basis. Room nights booked increased 9% from the prior year quarter. Good as well. Total revenues, an increase of 18% from the prior year quarter. So once again, gross travel bookings and total revenues are not the same, obviously. Gross travel bookings, we saw this in Expedia, right? This is just the money that people spend on the website. However, Booking.com then has to pay that money to airlines and hotels, and whatever's left over, they keep as revenues. Their net income was $222 million, a decrease of 82% from the prior year ago quarter. But there's a few one-line items that's why that's the case for that decline here, net income on the quarter at least. Non-GAAP net income was $1.1 billion. An increase of 18% from the prior year ago quarter. So once you remove your one-line items, they actually were net income, had a very, very decent quarter of net income here of $1.1 billion. Now, for the full year, since they just reported full year, gross travel bookings for full year 2023 were $150.6 billion, record year for them, an increase of 24% from the year prior. Just goes to show how strong travel demand was in the last year and should be in this year moving forward as well. Room nights booked increased 17% from the prior year. This was reiterated reiterated by Expedia and Airbnb on their earnings calls that everybody's room nights are netly to the upside. Very good. Total revenues, 21.4 billion. 25%, guys, increase from the prior year, and net income as well, increase of 40% from the prior year. It just goes to show you when times are decent and people are traveling again post-pandemic, this company generates a lot of money. Now, here's your one-line items, guys. During the fourth quarter and full year 2023, the company accrued a loss of 276 million related to the Netherlands pension fund matter, and a loss of 530 million related to a draft decision by the Spanish Competition Authority, both of which have been excluded from non-GAAP net income. So there's your reconciliation between these two numbers right there. A little bit of one-time items really plaguing the company right here. Now, they did initiate a quarterly dividend. As I was saying, our board of directors declared a quarterly cash dividend of $8.75 per share payable on March 28th, 2024. And what they want is they expect to pay a cash dividend on a quarterly basis ongoing forward. So very, very good. So quarterly dividend of about $8.75, right? It's not going to be so high in terms of the share price. $8.75 times 4 for your year is about $35. And Booking.com right now is trading at about $3,500. That's about 1%, right? So the dividend yield is not that high at only 1%, but at least it shows you that they are giving money back to the shareholders. Now, this company does do a lot of share buybacks as well. As you can see, over the prior 5-6 years, they've been buying back shares regularly with that free cash flow. That's also what you want to see in the company. So very good now that they're issuing another way of returning money to the shareholders with all that juicy free cash flow that they're making. Now, just to reiterate that they don't have a lot of debt, cash and cash equivalents at the end of the year, $12 billion, and their long-term debt, once again, $12.2 billion. So really safe balance sheet, in my opinion, no problems there whatsoever. Now let's take a look at some of their consolidated statements of operations here and show you a bit of percentage gains in terms of what we're looking for. So we're looking for, have their expenses exceeded their total revenues or not? Now here you can see 25% year-over-year increase in revenues. That's what we saw in the headlines. And we unfortunately have a 29% increase in expenses. So expenses coming up a little bit too quickly, in my opinion, in relation to the last year. It's not that bad, but still, total revenues, the increases are unfortunately not outpacing the increases in your expenses. And there's really no one-time items here that are too much to look at, except for your general and administrative expenses, which are up roughly about $800 million as opposed to last year. So that's a little bit of an outlier. Everything else fairly the same here. And this general and administrative issues have been covered in a lower section of reclassifications as well. Once again, a bit of a one-time item things. But if you were to remove that, guys, it would be roughly in line. It would be about 26, 27%. Revenues growing 25%. So operating leverage, not the best in the last year, but still not terrible nonetheless. Company is still solid in my opinion. And here's your net income for the past year, right? We were talking about a net income of 20% for the past year. And in 2022, they only had about 17.8%. So did a good job of driving money to the bottom line. Despite this relatively quick increase in expenses, they were still able to bring a bit more money to the bottom line here, increasing margins by about 2% in relation to last year's trading. Now take a look. The last thing I wanted to show you guys is their stock-based compensation expense and other stock-based payments. So it's about $530 million, and $530 million, right, when you're making potentially about $21 billion in your revenues here is not that bad, right? So 530 divided by your total revenues here of 21,365, you guys will see there's only about 2.4%, which is fairly decent, guys. So I'm not too sure why I wrote 10% here. I think I was confusing it with the INTUIT, and I put that there. That's a mistake here, guys. So your share compensation is actually fairly good for Booking.com. My apologies. It is only about 2.4% of their total issuance, we have their total revenues, which is extremely good. So all in all, guys, the company is solid. Now, to compare it to itself and its peers. So if we take into account the 2024 PE ratio, at a stock price of $37.20, where it was a bit before this call, right? Now it's about $35.50. Let's just take the $37.20, not change up the numbers. That's where it was down before when I was doing this analysis. 2024 PE ratio only becomes a 21. Not so bad. On trailing 12 months, they're trading at about 26 PE ratio. On a forward basis, about a 21. And that's not that bad in relation to the company's history. I don't have it up here right now, but they average usually about a 25, 26 PE ratio. So that's about standard. Next year is a bit better. So it does leave a little bit of room for the stock to appreciate to the upside as well. The 2024 PEG ratio, in consideration of this PE ratio and your EPS growth, is about a 1.44. So it's not terrible, not the best. Under 1 is good. Between 1 and 2 is fairly standard or average. So it's not the best, but it's not bad nonetheless. There is still some value to be had in this company. I do believe that in the next year, they will be able to recapture about $4,000, $4,200 in share price. In relation to just using a constant PE ratio and going with next year's earnings, that should give them a price forecast about between 4,000 to 4,200, which does represent some decent upside from here. We're talking about, 13 to 18% potential upside over the next year. Fairly decent. However, my favorite play still remains Expedia. Expedia, if you want to take a look at their numbers in comparison, take a look. PE ratio lower, faster EPS growth than Booking.com. Their PEG ratio for next year is only a 0.54. Expedia, in my opinion, is the best bang for your buck travel play in the game right now, which is very, very good. And if we do that analysis and give them a price target using a constant PE forecast here of about 15, so we're going to increase it a bit from 11 to about 15, which is still fairly conservative in the grand scheme of where Expedia's PE ratio has been in the past, right? Expedia's PE ratio sometimes was in the 30s, but it can go as low as the mid 20s. Now it's absolutely crushed on a forward basis. On a trailing basis, still high, but on a forward basis, you're still relatively crushed. So if we increase that PE ratio, midway between what it is now and 25, that's not even midway. I'm being fairly conservative here. So if we give them a 15 PE for end of 2024, and then we times that by their 2024 earnings per share, it gives us a price target of roughly $183 from current price, guys. That represents some very decent upside here, talking about 31%. So pretty much double Booking.com's. And even a company like Airbnb doesn't really compare. Their PEG ratio here, despite having decent EPS growth, it's just the valuation of Airbnb is a little bit high right now for what they are bringing in. Their PEG ratio is about a 2.4. So Expedia really has the best value in my opinion, but Booking.com, nothing wrong with the company. I may even be tempted to just make a little bit of a swing trade. If we come all the way back down here, guys, into potentially the 3,200 range, that would give me a lot better risk to reward. But as a whole, Booking.com, I like the company. Nothing really bad to say about the company as a whole. Now, the second company we're going to look at, guys, is going to be INTUIT. So INTUIT, if you guys don't know what INTUIT does, they are pretty much the industry leader in tax solutions. They also have a few other lines of business, notably Credit Karma, which is obviously to check consumers' credit scores. So they are an industry leader. They have very decent net margins, guys. This is a company, when we talk about INTUIT, you might look at their share price and you might think like, well, this has gone straight up. It's still at the all-time highs right now. And it's part of a group of companies, guys, that really represent well what Warren Buffett looks for in companies. So they have a very wide moat. It's difficult for new entrants to participate in their industry right now because they have such a large grasp on the entire industry right now. And he calls them toll booth companies, right? So companies that just sit back, operate their business, and collect tolls from the rest of the market. And that's exactly what INTUIT does. It's the same thing a company which is a potential direct competitor to INTUIT, Fair Isaac, right? The FICO score for your credit scores. So look at this stock as well. Same concept. Another example of the toll booth companies, guys. We're looking at Moody's Corporation, right? We brought up SPGI as well, MSCI. All of these companies, guys, are just so well established. It's so tough to dislodge them. And in the position they're in, they generate a lot of free cash flow, a very, very high net margins, which is why they do always trade at a premium. And it's very rare to find these having significant discounts. So unfortunately, if you want to participate, sometimes you just need to buy it where it is and just ride the compounding growth to the north, because they never really sell off unless we get a broad market sell-off back like in 2022. But you can see when markets are regular, these things tend to usually just churn up, grind up, and never really look back, right? So INTUIT, another example of that. They have a low amount of debt, which I'll show you right now. So in terms of their debt, not really looking at a lot. Excuse me for going through that a little bit here. So in terms of their total debt, you can see they're entering last quarter here with about $6.4 billion in debt here. And they did have a decent amount of cash and cash equivalents, about $2 billion. They've since brought that up in this most recent quarter here. But just to showcase you guys that they don't really have a lot of debt, considering the company brings in about $14-15 billion of revenue a year, this amount of debt is fairly manageable for the company. And they do bring in very good amounts of free cash flow. We're talking anywhere between $4 to $5 billion on an expected future basis here of free cash flow. So they'll be able to get rid of that debt if they do so choose. High amounts of free cash flows we just showed. Revenue growth 11%, EPS growth 15%. I mean, look at the consistency of this company here, guys, right? Just consistent EPS growth through 2027, consistent revenue growth as well through 2027. It just makes the company extremely predictable and easy to invest in, right? Really no red flags with the company whatsoever. The management team is extremely effective as well. This is where it has medium shareholders compensation. This is the one that I should have been writing here instead of booking.com. They have about 10% shareholder shares compensation for management and executives here, which represents, you know, it's not good, it's not bad, but still it's right in the middle. I'd like to see this lower considering some of their competition is in the 2 to 5% range, mainly talking about FICO and Moody's Corporation, S&P, SPGI to name a few, right? So they could get this down a little bit. It is hurting their net margins ever so slightly here. Their 2024 PE at $650, where they currently stand right now, is about a 39.63, which is not that, you know, it's not that low. Their PEG ratio is about a 1.91, so still a little bit rich, guys. You are paying a lot for the company's growth, but these ratios never really come down. If you take a look at the price to earnings ratio on a historical basis, right, you've seen that, yes, it's increased a lot in the past few years, but really it was never trading in the 30s. For the past 4 years at this point, not since 2018 pretty much, could you find this company trading at a trailing PE ratio of below 40. So investors are willing to pay for that growth. Why? Because they just keep increasing earnings per share. It's such an easy business to invest in. It's very predictable as well. So that's why a lot of these companies, INTUIT, FICO, SPGI, MSCI, MCO, we've talked about this every time we bring them up. They don't get cheap on a valuation basis. It's kind of like Costco. Since the company is just doing so well, they always trade at a relative premium, which is why when you see 10-12% discounts potentially on some market drawdowns, that's what represents the best buying opportunity for these companies. Not the best companies that you can swing trade, however. They're not very volatile. They just tend to grind higher as long as the rest of the market overall is healthy in terms of the macro. So let's take a look at a bit of their earnings here and see why they had a little bit of a drop here in the after hours. They're down currently about, I moved myself over, about 2.57% in the after hours. So not that bad. And that was just because they missed guidance on their next quarter. But you'll see when I bring up the numbers, guys, extremely solid company. So INTUIT reported second quarter EPS of 263, 0.33 better than the analyst estimate of 2.30. You can see that right here. I don't think I brought it up here. So you can see beat on EPS, substantial beat on EPS, and missed on revenue by 0.01%. So let's call that relatively flat, right? But here's the miss. INTUIT sees Q3 2024 EPS of 931 versus 938 versus the consensus of 9.7. So there is your guidance miss, unfortunately. But for the full year, they reiterate, sees full year 2024 EPS of 1617 to 1647. The midpoint there is about 16.3, right? Versus the analyst consensus of 1639. So kind of right in the middle there, right? Maybe a little bit under, but not that much. Now let's take a look at their financials here, and you'll see such a strong company. So we had another strong quarter as consumers and small businesses continue to rely on INTUIT's platform to power their prosperity. We have great momentum innovating across our products, and we're well on our way to becoming the trusted assistant that our customers use to fuel their financial success. So this company is well in tune here with small businesses. Obviously, their tax software is catered towards small businesses and direct consumers. So that's what they're talking about when they talk about that right there. Now, let's take a look at some of their highlights here. So you can see revenue on a quarter-over-quarter change in relation to Q2 2024, which is now, versus the Q2 of 2023, 11% bump in revenue. Here's a massive bump in your operating income here. Very, very good. So that's revenue minus a cost of operations here. Your operating income, 37% net change, which is absolutely insane, and a very decent increase quarterly basis of earnings per share as well. Now let's take a look at some of their lines of business and see why they're doing well. QuickBooks. So you guys must know QuickBooks, right? QuickBooks online accounting revenue grew by 19% in the quarter, driven primarily by customer growth, higher effective prices, and mix shift. Online services revenue grew 24%, driven primarily by growth in payroll, payments, and MailChimp. Total international online ecosystem grew by 16% on a constant currency basis. Very, very solid numbers, guys. Credit Karma, this is their one thing that they're lacking in a little bit, and that's because of how the revenue mix is divided. So here we go. Revenue was flat versus a year ago, primarily reflecting growth in Credit Karma Money, credit cards, and auto loans. However, offset by a decline in home loans, personal loans, and auto insurance. So little bit of cyclicality here in terms of their different lines of business within the Credit Karma unit. So that should be on the uprise, guys. The offset and decline in home loans, personal loans, and auto insurance. That's obviously, guys, because the fact that interest rates are so high right now, right? So capital allocation summary. In the second quarter, the company reported a total cash and investments balance of approximately 1.5 billion and 6 billion in debt as of January 31st. We went over that together, right? Not that bad. Could be better, but really not that bad. Extremely manageable for a company bringing in $15 billion of revenue a year and $5 billion of free cash flow. Repurchased 536 million of shares with 2.7 billion remaining on the company's share repurchase authorization. So 2.7 billion remaining. That's not that much. The company's market cap right now, it's trading at about 184 billion. So 2.7 divided by 184, you'll see that's not that much outstanding. They can only buy back about 1.5% of the outstanding float. So any ridiculous gains in share price is definitely not going to come from the fact that they're buying back shares. But just good to see that they are repurchasing shares. And they have another quarterly dividend approval, 90 cents per share per quarter, 15% increase compared to the same period last year. Very good. Here's the forward-looking guidance. INTUIT reiterated guidance for the full year 2024. Company expects revenue 15.89 to 16.1 growth. So this is going to be, in terms of billions of dollars, growth of approximately 11 to 12% again for the upcoming year. Operating income, again, 15 to 18% to the upside. Extremely good, guys. Such a solid company. And your earnings per share bump, approximately 11 to 15%. So that's what we were saying, right? In these numbers, revenue growth, 11%, EPS growth, always about the mid-teens for INTUIT. And they once again reiterated this growth metric as well. The company iterated full fiscal year 2024 segment revenue guidance for each of their segments, which just went over: small business and self-employed, their tax division, right? 16 to 17%. Consumer group, 7 to 8% growth. Pro tax group, 3 to 4%, and Credit Karma decline of 3% to growth of 3%, once again representing that different differentiation of the product mix here that we went over earlier. So, I mean, there's really nothing bad to say about this company, guys. They just keep doing what they do well, and shareholders just continuously getting rewarded for it. It's really hard to pick apart such a solid company, guys. So here's your revenue beat, 11% on a year-over-year basis. When we look at the 3 months ended, so this is going to be quarter, it's not a yearly report. So their total costs and expenses, right, however, increased by only 8.8%. So revenue outpacing your increases in operating expenses. Once again, this company, very good positive operating leverage. Their net income for the quarter is about 10.5% net income. Now this, in terms of how INTUIT usually performs on a quarterly basis, it's a bit low. I'm not going to lie, it is a bit low, but INTUIT, the way they usually work is Q3. Q3 is their Q4 for end of year, when everybody reports pretty much when they make a lot of money selling tax software going into the end of the year. That's where they make most of their net margins. But you can see, in terms of net margins, they're usually always hovering between 15 and 20%. So I do expect this number to go up. Still not a bad quarter for them. 10%, 10.5% net income for them. Very, very decent, right? And now if we go down here, there's a few things that I did want to show you as well. And the last thing I did want to show you guys is going to be the share-based compensation expense. So this is on a 6-month ended basis. So I just want to show you that this is where your 10% number comes. So we take that 970 number divided by your total revenues for the 6-month ended period. So let's say 970 divided by your 6-month ended, right? 6364 is going to be about, actually more than that, about 15%, right? So not the best, guys. That's the one thing, in my opinion, that they're lacking is their shares compensation packages for management and executives is a bit too high. It's literally the only red flag for the company, but the company is generating so much free cash flow, decent margins, low amount of debt, industry leader. I mean, there's really nothing bad to say about this company as a whole. Is it my favorite play in the space? Probably not. I do like MCO, so Moody's Corporation. I like SPGI a bit more, and I even like Fair Isaac a bit more as well. But Fair Isaac is really rich at this point, really can't be buying it up there. But Intuit, not a bad play after all. I just figured that I should present this to you guys for you guys to put it on a watch list somewhere. And if you do eventually see this stock come down as part of a broader market sell-off, potentially back down under $600, could be very interesting to pick up this stock as the revenue expansion, EPS expansion, everything is just so predictable with the company, guys. I just love companies like this that you can buy it, not even think twice about what you're holding and just forget about it and just let the compounding do the rest, right? So that's pretty much everything that I had for you guys in terms of Intuit. As I said, tomorrow we'll be delving into a bit more growth-oriented stocks in the names of Mercado Libre. Extremely good growth company, guys. If you don't know what Mercado Libre does, they're basically the Amazon of Latin America. They are one of the fastest growing companies and they have extremely good financials as well. And then we're going to be covering Square's earnings that came out in the after hours today. Square actually doing nicely on their earnings here today, up about 12-13% in the after hours. So I'll prepare a nice little earnings presentation tomorrow whereby we're going to compare them with PayPal, which is one of their direct competitors as well. So with all that being said, guys, let's now get into our technical analysis right away. And let's start it off with our major indexes. So SPY, what were we looking for? Well, we were looking for bears to potentially reverse this into a daily downtrend that never manifested because of NVIDIA's earnings. Obviously, the market now tearing to the upside. So we never flushed our previous lows. The bulls always maintained control in SPY. Where did they lose it was QQQ. So we were keeping an eye out on QQQ, but SPY aided by the fact that financials never lost a daily uptrend. Healthcare never lost a daily uptrend as well. Only QQQ. So SPY as a whole remains healthy. Daily bulls still in complete control at this point, guys. New all-time highs on the day, obviously. Now, any pullback just going to be looking once again for a daily higher low. Anything above 493, just looking for a daily higher low for further trend continuation. And unfortunately, seasonality just not manifesting right now. NVIDIA's earnings basically just canceled everything. Renewed bullish interest here. People still buying at all-time highs currently, despite the fact that markets have already run a lot into the early part of the year. Expected targets for a little bit of a pullback. Well, this previous resistance, 501, becomes previous resistance, should be acting as a bit further support. And your weekly uptrend just simply continues now, continuously in overbought conditions here on the weekly as well. But your weekly trend is just still intact. No weekly consolidation just yet because we never lost the daily uptrend. So this is just still one weekly move since our pullback here at the end of December. So your bulls just remain in full control here, guys. The bears had the hourly downtrend, but like you saw after NVIDIA earnings, the bulls just engulfing absolutely everything here. So very, very tough to short this market. Now moving up to QQQ. QQQ, same concept as well, right? So QQQ, same concept, but a little bit different. The bears actually had the daily downtrend. They had the 4-hour downtrend largely in motion as well, right? Big 4-hour downtrend, big daily downtrend as well. And that had started off weekly consolidation, right? First week in a long time where we cut yet last week's low, right? So we cut last week's low, but once again, the bulls proving extremely resilient in this market, now engulfing our previous move. So we will now look, now that we have lost the daily uptrend, it's up to the bulls to reset the daily uptrend to the upside. If we do consolidate from here, target your 12 EMA here, guys. The 12 EMA represents this previous resistance level. 12 EMA right here should be acting as a little bit of support. So if we do consolidate tomorrow into Monday, potentially going to be looking for this area right here, 430-ish, to be acting as support. touch and potentially go for another rally mode inbound. Weekly is also looking fairly good here. Have 3 beautiful legs of weekly momentum to the upside. And now pretty much if we start cracking your previous highs right here, not there yet, but if we do, guys, that will now be your new weekly higher low, potentially on for another leg for QQQ. So the bulls just remain in absolute complete control of everything. Monthly, weekly, and now back in control of the daily. So consolidation is only going to happen, guys, when we get an extended daily downtrend here. And for the most part, bears have just not been able to follow through. We've talked about this every time that it happens, guys. They just can't follow through with weekly consolidation. There's always something that gets in the way. Sometimes it's the rest of big tech earnings like late January, but this time NVIDIA earnings did it all by itself. So looking very good, guys. No red flags as of yet in the markets. I'm still wary, guys. It's very tough to buy up here, considering the fact that in the first 2 months of the year, QQQ is already up about 8% here. We still haven't really fallen back. End of February, early March seasonality, in my opinion, is still a play, but might just be a little bit delayed. Keep in mind, the next series of data is going to be mid-March for CPI, and then we have Jerome Powell on March 20th, potentially going to kick rate cuts back through May. So we'll see how the markets act in terms of that. Now, XLF Financials, one of our best performers here in terms of never losing the daily uptrend. So look at this, guys. We keep pointing this out, right? The 12 EMA, beautiful defense once again in the past couple of days, acting as an area of defense, and bulls just on to new highs, guys. XLF Financials, now you're going to be looking at resistance targets. We've just passed the last one at about $40. Your next area of resistance now becomes the all-time highs. 41.50 pretty much is going to be that area, and financials looking extremely good here, guys. Nothing bad to say. Once again, I'll reiterate my favorite play for financials. Charles Schwab has not been participating in the financials rally, still at very good value in the lower $60 range. I really love this company a lot. They're growing excessively well. They have high margins. They just have not been benefiting from a lot of the financials rally that we've had recently. So I'm expecting them to have a bit of mean reversion and come back. That being said, bulls are in full control here, guys. Any dip is just going to be looking for a higher low, anything above 39.30, looking for a higher low for further trend continuation. And now the bulls have used this area perfectly, right? We were looking for this area right here, previous resistance to act as support. It did in the past few days, coincide with the 12 EMA, now on to new highs, bulls in absolute full control. Now moving on to the healthcare sector. So healthcare as well was one that never lost the daily uptrend, just really keeping SPY healthy while QQQ was consolidating there. So daily uptrend simply continues on healthcare at this point. Daily, slightly overbought. Weekly, slightly overbought as well here, but bulls currently no red flags at all, guys. The red flags start when you lose the daily uptrend. So far, no sign of that happening. 12 EMA is going to be our guide for that as well. If we lose the daily uptrend and lose a 12 EMA, that's when, in my opinion, we're going to get further weekly consolidation. But as of now, no signals of that happening. Bulls in full control. Any dip at this point, just looking for a higher low above 144.23 for further price increases. And now we're well above our all-time highs. So even if we do have extended daily consolidation into end of February and potentially midway through March, so much space above the all-time highs. On the weekly, anything above 137.28, just going to be looking for a higher low. The all-time highs at this point, 142. I wouldn't be surprised if we now retest 142 on that weekly consolidation and just continue higher through 2024. Very good with names like Eli Lilly, absolutely crushing it since the start of the year here, guys. Take a look. Year-to-date gains by Eli Lilly. Can I find them right here? Yeah, year-to-date gains, right? They're already up 32% year to date. And other healthcare companies like HCA, which owns a lot of hospitals and makes a lot of money, even them, guys, they're up substantial 16% year to date. So healthcare sector really outperforming, which is what I said was probably going to be the case leading into 2024. Now our two last indexes are Russell stocks, still maintaining fairly flat. So QQ was up 3% today, but the Russell didn't really get much love, guys. That's because yields were slightly flat on the day, and the Russell is most responsive to changes in yield. So Russell, once again, still flat. Bulls still trying to shape up the continuation of the daily uptrend. That would be taking out 204.57. So if the bullish momentum continues in tomorrow, I need to see the Russell close above 201. If we can close above 201 here in this either tomorrow or into next week, guys, it's going to provide the best opportunity for the breakout and retest of this range when we do get that seasonality consolidation. And we want to be retesting this big red 2-year range as support to really prove that the bulls have mounted above this large area that's been plaguing them for the past 2 years at this point. So as a whole, bulls looking healthy, but still dealing with this area of resistance, guys. I need to see a close above that for the Russell. Until then, your bears still have a chance at turning this one down. Any chance they get on index consolidation, guys, they are probably going to make the Russell come down even more at this point, right? It's just not out of the woods yet. It's teetering on the edge of being out of the woods, but just not there yet. And obviously, if we lose yesterday's lows, 196.48, that just becomes a daily downtrend, guys. And we're just going to go into a furtherance of this weekly tightening range. Keep an eye on your 12 EMA. Has been good defense here since the November rally. And now lastly, the Dow Jones. Dow Jones, never really had any problems with the Dow Jones, right? We were in jeopardy of potentially losing the daily trend to the downside. That would have been a flush here of this level right here, 38,100-ish would have been daily downtrend and into a bit of weekly consolidation. But the Dow Jones said no with the rest of the market here today and just pushing to new highs. So daily uptrend resumed for the Dow Jones after consolidating sideways pretty much since the end of January. Nice little furtherance of the trend expansion to the upside at this point, guys. Any pullback at this point, just going to be looking for a higher low, anything above 38 to 300-ish, looking for a higher low for further trend continuation. If the Dow Jones continues north for the next couple of days, then this area right here, guys, is going to be a big area of previous resistance, which is now going to be support. Just break out, retest of the zone, and continue to rally here for the Dow Jones, looking very good, no red flags at all, and weekly bulls are still in full control of this weekly uptrend right now, right? RSI on the weekly, slightly overbought, but it's been overbought now pretty much for the past month at this point, still not slowing down. Signs of slowing down, lose the daily uptrend and lose this daily 12 EMA. Until then, your bulls remain in full control. Now let's move on to Apple. Right? So Apple, very decent day here today, 1.12% to the upside, rallying off of our lows. We were saying how we cannot lose these $180 lows. Why? Because if we lose them, you set the daily downtrend. You also set a first weekly downtrend on Apple ever since our past October, last year's October period, right? So that would not be good for Apple, but Apple playing some good defense. Now we are in bounce mode, and we keep saying, how high does the bounce need to go for the bulls to be healthy? Well, guys, we need to get at least to about 187. Bounce up to 187. It gives the bulls the best chance possible. That's the 61% retracement. If we get all the way up to 187, it sets the bulls up nicely to potentially get a daily uptrend, but it's not guaranteed, right? Take a look at this bounce right here that we had right here, right? So this was a 618 bounce, but still the bears were able to completely almost engulf it. But you see, the bulls bounced so much that it became hard for the bears to put in a lower low, especially with the fact that we have this massive green box area of support right now. It's the previous all-time highs. It's the October support level as well from 2023, currently still acting as support. So we'll see if this time they're able to bounce, potentially get rejected from these two yellow lines right here, which is overhead resistance, right? 187 to about 191, big area of overhead resistance. We'll see. Can we pull into that area, set the daily higher low, potentially rally onto a new daily uptrend? That would set our weekly lows in motion here, and we would be on to potentially either tighten up this range further into the year or give Apple the chance at a weekly trend breakout to the upside. One thing's for sure, guys, as long as we stay close or below 180, I will be writing Apple puts aggressively because I do believe that this stock has good value down there. Apple looking fairly good, no red flags at all. Now moving on to AMD. So AMD, obviously outperformance on the day because of NVIDIA earnings, right? So almost 11% to the upside. Absolutely fantastic day for AMD, but still not breaking out of our range, right? So we're still kind of trapped in this wide range here. We're talking obviously between the all-time highs of 185-ish, and to the low side is going to be your previous all-time highs from all the way back here in 2021 of roughly $164 to $158. Now, AMD, if they break this upside target here in the next couple of days, 185, it's going to be a crucial step for them. Why? Because that will be a confirmation of weekly uptrend resumption. So after consolidating here for the better part of the past 4 weeks here, we were saying that it was a weekly bull flag, guys. A consolidation sideways at the top end of the move using previous all-time highs as support could just lead to a bullish breakout if the rest of the market participates. And that's exactly what happened to AMD. So even though I didn't like their most recent quarterly report, you have to also know that AMD will be putting out a competing product to NVIDIA's over the next 2 quarters. So far they haven't delivered on that, but it's in the pipeline, and that's one of the reasons that people are bidding up this stock in anticipation of future growth. It becomes very hard for me to be buying up here without knowing how the market is being receptive to that new product, but still, on the technical basis, guys, everything is looking very good. But if we continue consolidating here, guys, wouldn't surprise me as well as the stock just catches up to its current valuation, still overbought on the weekly. If you do get a break, guys, it will be a break of your all-time highs. Weekly uptrend just continues, and then your weekly higher low just becomes here, 163. So everything looking fairly decent for AMD. Just keep in mind, guys, downside targets. And if the market for some reason falls apart and we lose this here, guys, well, just going to be potential at that point, guys, maybe even weekly downtrend on AMD, which would just be healthy monthly consolidation. And at that point, guys, I will be looking to buy anywhere below 150. 150 to 140 becomes my personal buy target. Now moving on to Amazon. Oops, my bad, guys. So in terms of Amazon here, we got a 3.55% to the upside day on Amazon. Very, very good day. We were obviously consolidating on Amazon sideways for the past couple of days, even setting a potential daily downtrend at the loss of these lows, but bulls reacting very nicely, playing defense around this 12 EMA. You can see really sideways consolidation, allowing this 12 EMA to catch up to the price, using it and now blasting off here. So Amazon will be concerned with overhead resistance targets 177 all the way up to your all-time highs 188. Amazon's going to be such an outperformer over the course of the year, guys, especially if they continue generating positive net margins and huge free cash flow. They are definitely going to surprise to the upside for the remainder of the year, in my opinion. So Amazon looking very good. As in terms of the technicals here, guys, we are now in a new daily uptrend at this point. So any pullback just going to be looking for a higher low, anything above 166, higher low for further trend continuation. Weekly is looking extremely good as well, right? Very nice weekly uptrend, bit of sideways consolidation. Moving on to our higher highs right now. No red flags for the company. I would not be surprised, guys, if Amazon really continues in gaining the levels. Downside targets obviously remain the gap fill down here at about $160. And that's where I'm personally looking to really make a heavy play on Amazon, is if we do retest this 160 area. But so far, so good. Now moving on to Google. So Google also performing fairly good here today, 1% to the upside, right? Google caught in this tightening range. So we will see, can the bulls use this momentum that we've recently acquired in the markets to crack our previous highs right here, 151. If you do that, your daily uptrend is regained. And keep in mind, this is where we lost the daily uptrend, right? So daily uptrend, loss of the daily uptrend. Now we've been looking to set the daily higher low into daily higher high. And the size of this bounce was significant, just like Apple, right? So this is another case where we got an over 618% bounce. You see how hard it was for the bears to retake all of this area of drop. That's why we look out for the 618 level. Any bounce above that gives the bulls the best chance of setting a higher low, not cracking previous lows, and potentially on to a daily uptrend. So we'll see, that would be a break of this. If Google can do that, they would really do a great job here in putting an end to this weekly consolidation and really continuing here on this weekly uptrend to the upside. Google targets are still 141 to 138 to the downside. So if we do perpetuate this tightening range here towards the downside, I will still be looking to play Google aggressively as close as possible, 141 to 138. Once again, that's our previous resistance, should be acting as beautiful support. Bulls really establishing some nice control. Now moving on to Meta. Meta, significant day to the upside, almost 4% to the upside on Meta. Upside targets remain $500 psychological resistance at this point. Still kind of sideways, right? Not really breaking out of this range as a whole. So still sideways consolidation for the most part. Daily RSI now is not overbought, but the weekly, guys, is still significantly overbought. It's been overbought pretty much since early January. So just goes to show you how long some of these things can stay overbought. Look how long back here from May through July. Meta was overbought, right? So weekly bulls, daily bulls, every bull is in control right now. Monthly uptrend is absolutely gorgeous. Weekly uptrend is still gorgeous as well, right? Beautiful consolidation, potentially moving to the upside now. Upside targets about $500. And obviously, guys, to the downside, well, if we lose the low right here, 461, without making a new high, that would be daily downtrend. Keep an eye on your daily 12 EMA. If you lose the daily downtrend, lose a 12 EMA, it would just be further weekly consolidation for Meta. And Meta at this point can't afford decent amount of weekly consolidation. If we come down, 420 area is where I'm personally looking to buy Meta at, but so far so good. No red flags, guys, just remains a hold. Now, Microsoft 2.35% to the upside. Microsoft setting the daily downtrend over the past 2 days, and now in 1 day, just back to engulfing bull mode. So Microsoft was one of the stocks setting a daily downtrend. Microsoft had not had a daily downtrend here since the month of September. So notable to us, right? But now the bulls have engulfed, giving new life into the stock once more. Upside targets, obviously 420. So if the bulls continue to engulf, they give themselves the best chance, setting the daily higher low, potentially above this 12 EMA right here, something like this, and just move on to a new daily uptrend. Microsoft on the weekly is looking very good as well. Just this past week or so was just healthy weekly consolidation. That's what we've been saying all week. Healthy weekly consolidation coming to meet the 12 EMA down here, almost at 190, and now potentially due for another weekly leg higher. Microsoft looking extremely good, and monthly uptrend simply continues as well. So in all these stocks, guys, I've been waiting for the consolidation. It's just not coming. The rest of the market just keeps being pulled up by, factors such as earnings from the rest of big tech and NVIDIA earnings. The market wants to pull back, and you can tell that, guys, between the earnings that we have had recently and your market breadth, right? A lot of the times it was big tech doing some of the heavy lifting and the rest of the market pulling back. And now we do have still a somewhat divided market between your interest rate sensitive stocks and your big tech that really doesn't care about interest rates because they're in such high demand and they usually run low amounts of debt. So the market still remains divided, but overall big tech continues to make it march higher. Now, Netflix as well, closing nicely on the day, up 2.5% to the upside. So Netflix, we'll see, can they clear on the week this 575 area of resistance? It looks like they will do that. So Netflix, we were looking out for the daily uptrend, right? So this move right here, daily downtrend, was the most beautiful weekly bull flag ever, right? So weekly uptrend after earnings, healthy weekly consolidation. I was personally looking, if the markets were to come down here, 530 down to 520 was my sweet spot. Didn't get there at all before moving on to new highs. So now your weekly bulls are in full control of this weekly uptrend right now. Never lost it. Haven't lost the weekly uptrend since pretty much, right, this October-November rally as a whole. Weekly uptrend continues. Bulls in full control. The daily bulls break out of your 575, retest 575. This whole area not only is 575 resistance from back here, it's also short-term previous resistance from after earnings. We've now mounted, sat on it, and now looking to rally. If you crack this 597, new daily uptrend in motion, guys, and then your weekly move is off to the races. At that point, guys, we'll be targeting up overhead targets of about 620, and your next target is 700. So Netflix looking very good. Bulls in control of absolutely everything. Now moving on to NVIDIA. NVIDIA, obviously outperformer on the day, right? 16% to the upside, and very notable on NVIDIA, right? How the RSI took a significant plunge in 3 days of trading on the daily and now back up a little bit. So we'll see, but most likely this will result in a little bit of negative divergence. RSI higher highs pointing down, price pointing to the upside, but NVIDIA can outlast these divergences more times than not, just of how high the demand for the stock is. RSI on the weekly is ridiculous right now, but you can see it was ridiculous from May all the way through July last year as well. So we went through big detailed analysis on NVIDIA yesterday. If you haven't seen it from their earnings, take a look at the first 20 minutes of yesterday's video. Let me move this aside for now just to do the technicals. So technicals looking extremely good, right? So the bears had almost engulfed the bulls completely, loss of the 12 EMA, which is what we were looking for. And now after earnings, guys, the bulls are back. So now your previous resistance right here at about $740 will become newfound support. If ever we top this move out in the next coming days, well, we're just going to be looking to sit on this breakout retest of the zone, potentially onto new higher highs. And as I was saying in yesterday's video, guys, I would not be surprised if NVIDIA over the course of this year goes to $800, $900, $1,000. Look, in the after hours, they're almost at $800 already. They can afford to go out there, guys. I mean, it will be earnings multiple expansion, meaning PE expansion, right? That the price of the stock will be growing faster than the pace of their earnings. But that's what happens in hype cycles, guys, where things are extremely in demand. The valuation can go that high and people will still be keen to pay for it, right? Usually the growth for NVIDIA is only going to drop off after about 2025 potentially. So for the next year, NVIDIA is still looking very bullish. Bulls in full control of everything on your technicals, guys. Any pullback right now, just looking for a higher low, anything above 660. higher low for further trend continuation. So keep an eye on that. Moving on now to Tesla. So Tesla trading up a little bit, 1.36%, but really a lot of interest rate sensitive stocks here, guys, today. You know, with such big gains in the market, a lot of stocks just doing a bit of nothing. And Tesla and a lot of solar plays were synonymous with that today, not doing much despite the index being up 3%. So Tesla still looking to protect this daily uptrend here. Higher low is set at 189.22. We cannot lose this, guys. If we lose this level to the downside, it's daily downtrend resumed by the bears at that point. If you get a daily downtrend after such a weak move up, guys, it's just going to be a weekly lower high and weekly lower low. Keep an eye on the size of this weekly bounce, right? If we get a weekly bounce and it tops out soon and we lose the daily uptrend in the next few days, guys, it's going to be a weekly bounce of only about 25%. That's extremely weak. If that happens, we most likely are going to roll over and head for lower lows. 180 to 170 is going to be the mark to look out for. Previous support and your downtrending channel line right here. But so far, the bulls playing defense need to see them break this level right here, 203, and then go for the gap fill here of past earnings about 207 all the way up to 210. That would put Tesla in a much healthier light, and then we can start really recapturing some of these levels, guys. But for it to be a really healthy bounce for the daily option to continue, needs to continue to at least 220, at best 230. If you really want to have Tesla have a shot at a longer form recovery here over the remainder of the year, but Tesla's still beholden to interest rates. And in my opinion, until we get some more clarity on interest rates, Tesla is just not going to move like it used to. As of now, bulls still in temporary control. But if we lose this control shortly and roll over, guys, it's just going to be a weekly lower high into potential lower low continuation into March. Now, the two last ones, Palantir and PayPal. So Palantir benefiting from NVIDIA yesterday, mentioning the word AI probably 5,000-6,000 times. That's a joke, obviously, but Palantir once again benefiting here from any news on AI as they are a pure play advertising company. I love the company myself. Valuation, a little bit high right now, but still momentum play, right? So daily downtrend was set by the bears, which means that weekly consolidation was underway. We are in process of setting the weekly higher low. I was keeping an eye out for this area right here, guys, 2150 all the way down to 20, previous lows of our range from 2021, and obviously our previous 52-week highs all throughout this past year. That's the area that I was looking for. So if ever we roll over, guys, if we set the lower high, keep in mind, since it is a daily downtrend, the expectation is for a lower high into lower low. It just depends on the size of this bounce. We'll monitor it over the next couple of days, but so far the bulls bouncing nicely, almost 50%. If they can get up to about 24, 25, that sets them up with a 61.8% of the move to the upside, gives them the best chance at resetting this daily uptrend. And if we reset the daily uptrend, guys, well, your weekly higher low is set, and then we'll be on for a potential next stab here at your higher levels, talking about $25.50 all the way as high as about $27, $28. So keep a close eye on that. Palantir, nice recovery here. Not out of the woods yet. The bears still have an attempt to send it down here. And if we do for some reason daily downtrend into down here, $21 range is where I'm targeting to make some plays on Palantir. Now, the last one, PayPal. PayPal struggling on the day here, up 1.51%, green day, but still not any outperformance, kind of like Tesla, right? Interest rates and all of these companies, I call them the forsaken companies for the future, right? Well, unfortunately, PayPal just not benefiting from the gains as the rest of the market has. PayPal still in a very big area of congestion, at least in the after hours with Square's earnings. It's up to about 59, still not out of the woods, guys, $60 to $57. We're trapped in this range. You can see how often PayPal gets trapped in this range, right? Is now still acting as support as we haven't broke below it, but I really need to see a break of the higher end of this range here, 60.21, right? Break of 60.21, daily uptrend would be back in motion, and then we could start really attacking this downtrending trend line that we've been in for the past 2 years at that point. Until that happens, significant momentum to the upside for PayPal is not going to happen, guys. Break of this trend line is when all of your technical indicator algos are going to start firing off signals, and also it's going to attract a lot of retail attention, and that's when you're going to get the momentum. But as long as we're trapped down here, guys, not going to do it. Is it looking okay? It's looking okay, guys, but it's not looking fantastic. And what I want to see for it to look fantastic is mount above 60 and then mount above this $62 level. Really start gaining some of this gap fill from your previous earnings, right? So still tight consolidation. A loss of 57, guys, would be very bad for the stock. It would be daily downtrend. And if we close below 57, as I've been mentioning, guys, it's just not looking good. You would lose all of your weekly structure as well. Look at how much this area has been acting as support. If we were to lose this, unfortunately, you lose this weekly uptrend with a close below. And at that point, guys, we're heading to 55, even maybe as low as $50 at that point. So maintaining this area is absolutely crucial for the technicals of PayPal. So we'll continue to monitor this closely. As I've always said, if we come down lower, $55, $52, I will be buying more PayPal. I sold my shares before their earnings, just looking to protect capital here at about $63.50. So any discount I can get down in this area, I will be playing it. Still love the company long term. So that's everything that I have for you guys today. Hopefully you guys enjoyed the video. Once again, if you did, consider dropping a like, would really appreciate it, and consider subscribing to the channel if you're new. We do these video updates Monday through Friday over the course of the week, covering earnings during earnings season and portfolio reviews Monday and Friday sessions. So hopefully you guys enjoyed it. And as usual, if you have any questions whatsoever, consider dropping a comment down below. Anything you want, if you want me to look at a specific stock, some earnings maybe that I've missed, technical analysis, options plays, whatever you guys want, leave it down below and I'll get back to you usually within the first 24 hours. So take care, guys. See you tomorrow, Friday, after the close. Happy trading. Peace.